Welcome back. Today, this is this is what we're going to talk about, whereby you say big boys play on the higher time frames. Yeah, that's my opinion, right? And this one does not mean that guys who trade on the lower time frames don't make money. I am just giving my honest subjective bias with a little bit of experience that I've had on charts, whereby I am going to talk much on this issue here. The too much stop loss refinement means that your order limits will not likely be triggered, right? There's also this aspect of when you're trying to refine your stop loss so much, it is an indicator that you still have some fear. Yeah, you still fear some of the results that a setup is gonna print, it's gonna give you. But before I talk all about this, let's look at GBP/JPY. This is GBP/JPY on the daily time frame. I broke down this setup right here. The way we smash this target following the bullish version of the standard trading model. But today I'm just going to focus to this area here, particularly this guy here, right? As you can see, there was we are following the bullish version of the standard trading model, like this, right? We said we need a sweep of liquidity, then our first structure right here, and then at this lower low, this is where we set our buy limit order to potentially take these high highs. But you can always take partials that occur on the liquidity lying on this leg right here, on this leg here. So right here we can see there was a sweep of liquidity right here. And now the first break of structure, the lower low that is conspicuous right this week here, this guy here, this guy. We can see this guy was taken. The market went up, came down, manipulated a bit. This one I did on some video that the market at 90% will first of all take liquidity, then reverses, manipulates first before it goes to the direction it wants to move. So there was a manipulation here, and we're seeing now it is rallying up. Yeah, potentially maybe we will take this high. This is our prediction, because in markets, what we usually do is just prediction. We predict what the direction or where the market is going to draw in liquidity. That's predicting. You predict you predict. You see, when you set this order right here, buy order right here, you're predicting that this market is going to smash these high highs, or you're predicting that this market is going to move high, whereby you can take your partial profits along this leg here. This is a prediction. Prediction, when you predict, it does not guarantee that you're going to win, right? You predict, sometimes your prediction don't go as you had intended, right? Sometimes your stop loss is hit. That's what prediction means. Yeah. So it's important to have a model that gives you some form of certainty when you're trying to predict. Yeah. If you have a model that gives you like 90% of your prediction going as per your prediction, that is a good thing. That is what an edge is all about. So we had a sweep of liquidity, that small manipulation here, then we rolling up. As we are rolling up, you see this market went up and we formed, there's a first leg and there was a first break of structure right here, still following this model. Then it's low right here, you can see how we smashed it and we are now going up. We will take this relatively high highs, relatively equal higher highs. This is where the liquidity is right. Move up there. Yes, that is it. As we are continuing, see with this sweep of liquidity, we said following this model, see there is a first break of structures, a low leg right here, this guy here. This is also where we supported our order. But as we are on the daily, we are not finding it very okay. Let's just watch it here. This one just still on the daily. This just a small lipstick on what I was trying to break down. Sweep of liquidity right here. This guy was the first break of structure lower low, just following the bullish version of the standard trading model. See, on the daily, we can think that this market has smashed our stop loss right here without giving us anything. But as we drop down on the lower time frame, you'll see what was happening around here. Yeah, let's move. Now this one right here is still the same chart on the 4-hour time frame. This is the first break of structure that we saw after the sweep of this liquidity, this guy here, and we can see there was a reaction of that zone right here. I mean, you could have made some pips. It was around what pips. I just I confirmed around 30 plus pips, because you can estimate you get this at 9,400, right? Oh, it's low 400. Then this high something 80. Yeah, 400 minus 80. So it's around 40 pips, 30 at above. So you just take your partial profits and you get out. That's what you can say. So this was the first break of structure that we saw the day. This one is very clear now here. You can see this guy was taken, this liquidity, this first break of structure lower low was taken, and now we are rallying up. Right? So this is the move that I'm going to focus so much today. Moving on, this one was on the 1-hour time frame. As you can see, this was the liquidity that was taken, and this is a reaction that we just saw on the 1-hour time frame. Yeah, with that sweep of liquidity of that guy that wicked down on the daily. There was no sign that the market at least rejected a bit, but you can see there was some profits here, some money here. People have taken advantage of. See a sweep of liquidity right here. Yeah. See this market rolled up, rolled up. Yeah. But I want to put so much focus on the 30 minutes time frame, because this guy, the 1 hour is not that very clear. So using this model, it is very important to check all time frames, right? Yeah. If you're not seeing anything if you're not seeing anything of substance on this time frame, on the 4-hour time frame, then you drop down on the 1-hour time frame, right? Mostly when taking entries, you take entries on the lower time frames, 1 hour, 30 minutes, 15 minutes, yeah, 15 minutes, 5 minutes. You can take your trades on any time frame. But I will just give my honest opinion on taking trades on lower time frames. Yes, so this one was on the 1 hour. You can see there was kind of sweep of liquidity here. You can see this week. It means it simply means that it's very clear that this market was trying to come and sweep some liquid fast break of structure right here, which is not visible on the 1 hour time frame, as we can see, right? And this market rallied up right here and dropped down. You can see. Then take this guy again. They're taking this guy. Let's just drop down on the minute time frame. Okay. So this right here was the 30-minute time frame. This was the liquidity that was swept, as we saw on the daily. So this now is very clear. Yeah, with this move. I hope we are together. This one, let's find an expanded version of it. This one is still on the 1 hour, but an expanded just version of it. See this move here. You will wonder where was the first break of structure. This market just reversed. Yeah, but dropping down the lower time frame on the 30-minute. This is what you can see. After the sweep of this liquidity, still following. I hope we are together. I don't want to be repeating things one thing so much. But that's what trading is, repeating one same thing over and over again. When it bores, when you feel like giving up, that is when now profits will flow on your account. So a sweep of liquidity, this is the first break of structure, the clear one. Everyone can see that. This lower low, this is where we take our buy order to potentially take profits of this guy right here. The target smashed right here. Yeah. Take your money and run. Leave the market to do whatever it wants. With this sweep of liquidity, you can also see the first block of structure that you can see it was right here, right? And this low is right here. I don't know. You always look for a quality setups where you can predefine your risk, because this risk right here from that end to this end, from this low to where stop loss should be. So you should weigh the trades to execute, right? If you can, bear all this loss, all this risk exposure, then well, you can take it. You can see this guy was taken, and boom, we took this guy. Take profit smashed. We come down, we set that lower low again. Right here, the sweep of liquidity. This guy was not taken, so we are still, our buy is still bullish, because if we take this guy, that's when now we can change our mind. Right, we smashed it up. You can see this guy was taken. This was kind of news. So this week was not just a normal one, right? And with this guy still, so liquidity was swept here. This market rose up, rising up. So this is the leg. This is the leg right here. This is where we were to look for a fast break of structure. But is there any visibility, any sign of the first break of structure on the 30-minute time frame? I don't see any. Yeah. I don't think if you can call this one a first break of structure, because we normally you look for a first break of structure in between this leg before this high is taken. You can see this guy has been smashed, forming this lower low, where the market reacted off of it to rally up to take these higher highs. This is the leg that you're looking for, the first break of structure. Let's drop down on the 15 minutes time frame and see what the market was doing still on this move right here before we make some conclusions. This one right before you is now on the 15 minutes time frame. You can see this is where we took our order, our buy order on the 30-minute time frame. But you can see after this sweep of liquidity on the 15 minutes time frame right here, you can see the first break of structure that's clear is this guy. You can see right here. Yeah, you set your order here, you miss out. Your order is not triggered. We rallied up. First break of structure, still as we saw on the 30 minutes time frame, was smashed to take profit right here. There was this guy taken. First break of structure, still not clear on this leg. But what we can understand, after this guy was taken, this guy was formed, right? So taking this guy means a sweep of liquidity, right? After you take this guy, you will always take our trade. So our bias is bullish after this market structure shift right here. Over to somewhere here, right? This is why you call for taking your order to target this high right here, because all this one was not that clear. You see after the sweep of this liquidity, right? Maybe you can say there was a market structure shift over here. Oh no, this guy here. All this what is lying here was liquidity. But we needed to be sure that this guy was going up with market structure shift. This liquidity was taken, still swept liquidity, and this guy becomes stronger lower low. Becoming a stronger lower low, this guy becomes first break of structure. And what did we smash this guy to move up? Maybe. We confirm with it. And we rallied up. That is it. We are just focused on the bullish side because we are on the bullish. Of course, on the bearish side, you can also see some beautiful setups that people have maximized on. But it's good to always pick the bottoms to follow the trend, whereby you pick. Okay, let me talk that aspect. While trading, it's not that very good. It's not that for your own advantage, for my own advantage. It's very important on a bullish market. When the market is bullish, you always try to pick at the bottoms, right? When this market is bullish, see this market is bullish like this, we always try to pick the bottoms. Just still a bullish version of the trading model talks everything. It explains everything. What you're trying to do here with the bullish version is that after this first break of structure, this market is moving up, of course. This market is moving up, of course. So what you're trying is to pick these bottoms right here. And it will be nice if you would find your first break of structure closer to this lower low right here. Pick those bottoms to rally up. And in the bearish version of the standard trend model, we always try to pick the farthest, the first break of structures, the farthest. Pick the tops for the bearish market, rather than the market is bullish. The market is bullish like this. You're trying to trade against the trend. You're trying to pick the tops. You're trying to stand against a falling knife. You're trying to catch a falling knife. What will happen? See, anything, markets, anything can happen, right? And how about when something happens that it is unusual? Your stop loss will be smashed so quickly than if you are following the trend, right? So what I was trying to say that in this rally here, we're trying just to pick the bottoms, but of course, looking even on the bullish side, we could have found some setups, many of them, yeah, to take advantage of it. Dropping down. You can see reaction here. So that is it. Now, talking on an issue of let's go back here. Let's see this guy that liquidity swept on the higher time frames. Oh, this was a question. The liquidity swept on the higher time frames and that swept on the lower time frames. Which one is more likely to respect? Which one is more likely to hold? Right? Which liquidity is more likely to hold? And let me bring this. Let me try to explain this in terms of a scenario illustration. See, there was a higher time frame. Yeah, it took a lot of time to form that swing where that liquidity is lying, and this one lower time frame, it took a shorter time to form that lower low or that high. Now, let me say this now. Let's even reflect with a trader experience. You see, I can't compare myself. I can't compare the experience I have right now in trading with the experience that I had when I started barely 3 months when trying to understand what the charts were doing. The experience that I have right now is more likely to give me wins over losses, right? I know what setup is working. I know the inadequacies of my setup, of my model, rather than 3 months ago. 3 months barely when I started trading, where I didn't know what to do. So time is I'm just trying to, though that's not a good illustration. I'm trying to bring out the idea of time, right? That the longer the time a swing is formed, that is on the higher time frame, the more it holds, it's likely to be respected. After the sweep of that liquidity, there will be some reaction of that zone as compared to that on the lower time frame, right? The market is likely to disrespect them. Now, I think we should just put this into perspective with the illustration on charts. We can see the way these swings are held, right? This guy is not taken because after the sweep of all this liquidity, we expected this guy to react or to take this high. You can see it has been respected very good. This guy also expected this guy some reaction off of that zone to be taken, right? This is also still in the daily. This guy here, we expected some reaction off of it, and we just saw on the 4 hour and the guy and just seeing what had just happened here. Right, there was some form of reaction of that zone. Yeah, this was a reaction. That's a liquidity that was swept on the daily time frame. Now let's compare it on the lower time frame. I know this. I'm not this. This proof is not that very clear. Maybe I'm going to look for another. For another illustration, another proof. But I think you understand the concept. But all in all, see, the market is fractal in nature. What happens on the high time frame, liquidity sweeps on the high time frame still are the ones swept on the what? On the lower time frames. So there was this guy hold. This guy here was held. Swept. This guy was taken. Okay. You see this guy? What are you trying to explain here? Nonsense. I am lost. But that is what it is. It is what it is. Yeah. I hope you're getting my point, right? Like, it's very good to play on the higher time frames. It's very important to play on the higher time frames because those liquidities have this. I don't even know how to explain this. But it is what it is. Yeah. So moving on, we have this guy here. Too much stop loss refinement means your order limits are not triggered, right? That's true. Most of us traders, I know for those guys who trade with order limits, buy and sell order limits. You find that you place your order limit and the market just barely touches. That triggers your what? Your order, and market just hits a take profit. Hey, man. You see, your order was not triggered. Just market came. Your order was not triggered. The market just hit a take profit. What will you feel? What is your emotional? See, that is you'll be disappointed, right? There will be a lot of disappointment, right? Yeah, you will be making money with your eyes, right? There are many regrets right here. There are many regrets. What is regret even? No. Regret is something, I could have done this. See, you had an opportunity to do this, but you never did it. You never did that. So you had an opportunity, there was a chance of your order limit being triggered, but you did something that made your order limit not triggered. That's where regret comes in. That's why I said it's risks better than regret. Yeah. There was a chance for you to risk. You're setting your order limit on the higher time frame. Okay, let me put this into perspective with this guy we just seen here. Though this is just one example of it. You can go deep to your charts and try to look for this the way how your order limits were not respected, or you can go back and look at your journal, all the trades that were not triggered. What was the reason behind it? Because I found out that most of the trades that my order limits were not triggered and take profit or hit was because I refined my stop loss so much, because I did analysis on the higher time frame. I was dropping down now to find a sniper entry, like that is the name of it, sniper entry, which my order was not triggered, right? Yeah. The guy, see, we see the first break of this lower low. You set your order limit, your stop loss right here, right below here, stop loss right below here. But as we saw on the 15-minute time frame, right here, we saw other fast break of the clearest one. See? Yeah? This is the lower time frame. The more you move down on the lower time frame, so you set your order limit here, your trade is not triggered. The market just reverses on the higher time frame, sweep of liquidity. That's now the aspect of where we'll see that the higher time frames liquidity sweeps are much likely to be respected and forgetting about those lower time frame liquidities. See, this was higher than this, so this guy was respected, and this guy, yeah, that's the point here. When setting an order, it is very important to set your order either buy or sell order on the higher time frames, fast break of structures, lower low, in relation to a bullish version of the trading model, or you set your order on a higher high, on the first break of structures higher high, that is on the bearish version of the standard trading model. Rather than, you see, okay, let me put this way. You have two fast break of structures. Okay, let me do it this way. You're analyzing a market. See? Normally, when you analyze a market, you do top-down analysis. You begin from the higher time frame as you drop down to the lower time frame, right? So as you drop down on the lower time frame, as just done on this trade, right here we began on the daily, we came on the 4 hour, and this one right chart here, this chart right here was on the day on the 1 hour. After the sake of this liquidity, we were looking for the first break of structures lower low. We are looking for the first break of structure on this leg right here, right? And we never saw one, right here. Never saw one. So what we do, we drop down on the lower time frame. Now dropping down on the lower time frame, that's a 30 minutes time frame. Now we can see a first break of structure, the clear one right here. And this lower low is where we are supposed to take our buy order to target these heights, right? When we see this first break of structure on a 30 minutes time frame, this is where this is the time frame that we sell our sell order. This is the lower low, first break of structure lower low, that we set our buy order. Because if you dropped on the lower time frame, you would find another fast break of structure, as we just illustrated on a 15 minutes time frame. Yeah, this guy here. Yeah, this guy here was the first break of this lower low. Yeah. When you move down on the lower time frames, when you're trying to refine your stop loss right here, your order, the market will leave without you. Of course, the most important thing is to know where you're. I discussed some video. Most important thing is that when you find out that this is where your order is supposed to be set, your buy order is supposed to be set, then I said you just measure how far is your point of stop loss to the point of your entry. How many pips difference is it? Yeah, with the number of pips, then you can play with the lot size, right? If you have predefined to be losing a certain amount, a fixed amount of money, right? You can take that amount of money. Say you're trying to risk 2% of your $100 account. 2% of $100 account. That is what? 2%, 2 over 100 times 100. Yeah, that's $2. Huh. Okay, you're trying to lose 2% of your $100 account, which is $2. You're trying to lose $2 in every trade. That's one of your rules, because we always set our rules. With every trader has his own rules, right? His own trader has his own rules, and it's very important to follow your own rules. Yes, so you're trying to lose 2% of your $100 account in every trade. So what you do, see this distance here, you check that that risk amount, the $2, then you divide $2, the number of pips that are lying in between here. Say this around, say just a word, an imagination. Be 10 pips, right? If you are 10 pips, then the lot that you are going to use, lot what? 2 divided by 10, you're going to use lot 0.2. Yeah. You do that with any setup that you meet, right? You find the distance between your point of entry with the point where you're supposed to set your sell, your order, either buy or sell. You divide the amount you're willing to lose by the number of pips in between your point of entry and the stop loss. Then you get the lot size. You see, there's no point of saying that I don't think it's a good idea to say that in every trade, every setup that I meet, I use a specific fixed amount of lot size. Say I use 1 standard lot in every trade. My friend, you'll find a setup that will make you lose good amount of money. Yeah, unless you have predefined amount you're going to lose, and you say, thank you. If you say it's okay, yeah, but that is there will be no point. There will no. See, when you just choosing lot, you're just putting lot sizes. When you just are using fixed lot size. What is the point I'm trying to say? I'm trying to say this. See, having predefined an amount you're willing to lose in every setup, okay, gives you some form of makes you some form of self-responsible, right? Yeah, there's some form of structured freedom. There's some form of what can I say? Okay, compare these two guys now. Someone just open chart, see his model, and then decides to use one standard lot, gets in. Okay, decides to lose one standard lot. When he tries to calculate his loss on that trade, it will come around $5. We're just still considering this guy $100 account, right? This guy in this setup with a $100 account with this setup has calculated his loss to be around $10 in that setup. The next setup he meets, calculating his loss is gonna come maybe $5. The next setup is gonna give him like $15. See, there's no commonality. Commonality is the word. Yeah, there's no grounds. Okay. What I'm trying to say is that it's good to have a fixed amount of money that you're trying to lose in every setup that you meet. You don't have to over leverage. Yeah, that's the word, over leverage, right? Use a leverage. Use a lot size that goes with the risk exposure that you have in the markets. this stuff. Okay, let's continue and see. I hope you're getting me, and I'm not so much over boring. When you lose, when your order limit is not triggered because you decided to refine your stop loss so much. There are many examples of this. Just go back and look at your trading history for all other limits that were not triggered. Try to find the reason why they were not triggered. You are most likely going to arrive to reason being your stop loss was too tight, right? Let me bring another aspect. With the bullish version of standard trading mode, right? This is where we take sweep of liquidity. This is where we take your order. This is what I said, you take your order. With this first break of structures, lower low right here, this is where you take your order. So this one is on the higher time frame. That point is not coming out. I won't deliver it well. So when your order limit is not triggered, of course you'll be disappointed, right? You see your take profit being smashed. There'll be some form of anger, yeah. You will be disgusted so much. Then what will happen? You'll have some form of, you'll trade with some form of revenge, yeah. You're trying to revenge the market for missing out, for missing out of that money you made with your eyes. With the revenge trading, what normally happens? Your mind is clouded, right? You will tend to make the same mistake that you made before, right? When you revenge trade, when you put in the next trade and you're trying to revenge the market, see, you just set your mind that for this setup that you're going to take, for this trade that you're going to take, it's going to give you profits. It's going to give you a win. When you revenge trade, you will not put in consideration an aspect that every moment in the market is unique. You have set your mind in a way that you think that I am going to execute this trade and I don't want any other result other than a win. And there's a problem with that. When that trade turns out to a loss again, still the cackle continues. Disappointment, much disappointment, anger. Go again on another revenge trade. You go to remove to another trade. The only thing that can stop you is either your account get blown up. Yeah, that is it. That's the only place that you get stopped. Or you come back to your conscience, right? Your conscience helps you and you stop trading. But if you continue, your account is up. Yeah, that is it. So it is important to risk that trade on the higher time frame, put that order on the higher time frame, right? Rather than regretting for not having an order limit on the higher time frame. Does too much stop loss refinement an indicator for fear? That's a question that I asked. Yeah. See, what you're doing when you're dropping down on the lower time frame is that you're just trying to refine your stop loss, right? But once you find your point of entry on a 30 minutes time frame, then you are trying to now go to still drop down on the low time frame of 15 minutes or even on the 5 minutes, because I'm very sure on the 5-minute time frame there was maybe a lower low first break of the first break of structure that we just seen on this chart. Well, you're still moving to the point to where your stop was supposed to be made. It means that you still have some form of fear of losing, right? You still have some. You don't want a market to go against your direction. You just want to pick a sniper entry without. You're trying to say that you just want to get into. You just want your limit to be triggered. Market just triggers your limit and boom, right? Rather than you don't want to experience market coming down, gives you into a bigger drawdown, then values up. You don't want to see this. Just want to see a sniper entry, right? There's some form of fear. It still means that you don't trust your model. That is it. Still means you don't trust your model. You don't want to see the red what? The red, your account turning red. You just want to see your order limit being triggered. Ta-da! Then boom, you're on the green. You're in profits. It does not happen that way. One premise for profitability is that for profitability is that you accept the risk. Right? Trust your model, set your order, accept that risk. If stop loss is matched, then well, you're good with that. That's a moment to learn of your model. That's what I can say. It might be an indicator of you still have some fear of executing, or you still have some fear of not accepting the risk of the trade that you're putting. It's still an indicator that you don't trust your model. Yeah. That is what I think is all about trading on the higher time frames, setting your orders on the higher time frames, and trading on the lower time frames. So that is what I can say today. Thank you so much and for watching. If you've gotten something, always like the video and share the video. And we move along together in this market. Yes, that is it. So the last thing is that this guy. Let's watch this HTF.We. I think I'm going to begin a series on each pair of currency whereby I will follow each pair of currency that I trade. Let's see, like the GBP USD with GBP JPY right now. So we are trying to track this guy slowly by slowly till we smash this high following our model. Yeah, that is it. Every pair following closely. Thank you so much, and take care. Bye.